All right, welcome everybody. This is John Rothe at Riverbend Investment Management. Welcome to our Big Picture Weekly Market Update. This is going to be for the week of December 9th, 2022. So to start off with, let's take a look at our index matrix. I have a couple things that have really been changing over the last couple of weeks. What we've seen is just this continued weakness in the U.S. dollar. The U.S. dollar has really been fairly strong this year, which has been having a negative impact on stocks, especially the growth names. But we're seeing this continued weakness in the U.S. dollar for short term, and now the long term indications are starting to point downward as well. What we've been seeing is that's really been benefiting the value stocks. The S&P 500, this value side has been doing fairly well. We're seeing international markets start to pick up, obviously, because that's the impact from the weaker dollar. And then the Dow Jones index, which is kind of more skewed toward the value side of names, has been doing fairly well as well. We are seeing this kind of an expansion within the market. We are seeing these short-term and some of the longer-term indicators start to indicate that these longer-term trends are starting to take place, especially across the board here with even the growth names of the market, which have been kind of playing catch-up with the value names of late. Looking at our sector leadership, we see here again, healthcare, utilities, consumer, industrial, financial, energy, materials, all value names have been taking that leadership role within the market, which is vastly different than what we've seen since 2008, 2009, where the growth stocks were really the leadership names of the market. So we could potentially be seeing a change of longer term trend that favors the value names, but we're kind of in the early innings of that if that happens. But really, again, this kind of spreading out of names, we're starting to see broader and broader participation within the market, which is a good sign for investors. Talked a lot about seasonal patterns this year, and I wanted to zoom in on December and what that looks like. So this is just the average December going all the way back to 1900, and typically December tends to start out slow, which is exactly what we've been seeing this past week in the market. Not a lot of strength in either direction within the market. And what tends to happen is you get these large institutional funds, the large institutional investors will take this time of the year to do their tax harvesting. So what they're doing is they're taking their tax losses by selling those losers within their portfolio. Well, eventually that money has to re-enter the market. And that's where we start to see that late year-end rally, especially as we get closer and closer to Christmas, kick in for the market. So a lot of things for especially the last quarter of this year have been lining up with a lot of these seasonal trends. And the more and more those start to line up, you start to see investors start to pay attention to it because the odds favor the markets to follow those rising trends. So just another sign that this seasonality might be starting to kick in for the market, and which again is very good for investors. Looking at the S&P 500 index, we talked about this last week, this downward trend, this red line here, how it's been acting almost as a brick wall for the market. And every time we've gotten up to this level, the market gets rejected and comes back down. It looked like last week we were starting to slowly break above that level, but unfortunately it looks like the market has turned back down. But that also happens to coincide with that early weakness in December. We're trading around a slight support level here, but we are trading above the cloud level, which again is a good sign. So if those seasonal trends can kick in and we can break above this downward trend line, I wouldn't be surprised if we really retest these recent highs fairly quickly, because I think you're going to see a lot of money come off the sidelines as this trend is broken and start to re-enter the market. I do want to point out this 50% retracement level. We've talked about these Fibonacci numbers, these Fibonacci levels in the past, and what they are just really retracement levels from the COVID low to the recent high. And this 50% level acted as really as a support level for the market. As the market came down to this level, we saw the markets rise fairly aggressively from this level. The reason I point that out is it happens to coincide with the 200-week support level. The 200-week moving average, What this is the S&P 500 on a longer scale going back to the mid-90s. And this red line here is the 200-week moving average. And you can see here, every time we've come down to that historically, it has happened to be a fairly decent time to enter the market. And what's been different this downtrend in the market that we've had this year is it hasn't broken below this 200-week level. In fact, it happened to coincide nicely with that 50% daily retracement level, and it just started to bounce up. So as long as we can stay above this red 200-week moving average, that's going to be a positive sign for the market. You can see once we really break down below that, we have to start talking about scenarios like 2001, and 2008, 2009. But so far, the market has been holding above these levels, which again is another good sign for investors. The Merrill Lynch High Yield Index, I like to keep an eye on this as well. The red line is a 50-day moving average in this chart. And what we can see here is it's still rising. Every time the level is above this 50-day moving average, it's an indication that even the most conservative investors in the market are starting to take on more and more risk. So if you think about the bond market, these they tend to be very conservative investors. And the high yield part of the market, which are your corporate bonds, are that more aggressive asset class within the bond market. So to see money start to flow into this area and start to see this area start to participate in the market in a rising trend, that's another indication that these more conservative investors are starting to come off the sideline. Looking at our sector rotation charts, if you remember, these tend to rotate in a clockwise fashion. This upper quadrant here is the strongest area of the market. This red level is the weakest area of the market, and this is all compared to cash. And remember, we always say we want to invest in areas that have stronger momentum than cash. Well, for most of this year, that area was only energy, but now we're starting to see these value names improve, and we're starting to see a wider and wider participation in the market as these other sectors start to improve as well. We look at if we look at the energy sector, I think the energy sector is starting to kind of teeter out here. We might start to see it reverse down a little bit, and that isn't due to the oil sector. Oil prices continue to collapse. We've seen it break through this very important level of support that a lot of the market was watching, and it continues to break below that level. So it's a good sign for consumers, anybody looking to fill up their gas tank, and it gives consumers a little bit more money to spend on items outside of gasoline. Looking at NASDAQ, NASDAQ has been slow to catch up here. We can see we're having trouble getting above that 50% retracement level, having trouble breaking above this cloud model, which again acts as support and resistance. But we are starting to get a little bit oversold, and we are starting to see this rising trend form in part to the semiconductor stocks, which have been starting to show a rising trend within the market. This has been the kind of the theme for the last quarter here. Once we hit those lows earlier in the fall, the market started to rise, and it's really favored value stocks over growth names. So we want to start to see some of these growth names start to participate in the market. And I think some of that leadership is going to come from the semiconductor names. This is that same sector rotation graph, but it's zoomed in on the subsectors. So think of them as sectors of sectors. And really, we're starting to see this leadership area in the semiconductors start to improve rapidly, which again is kind of a good sign for those growth names. And we're starting to look at this broader participation in the market. We're really seeing more and more sectors start to gain a positive relative strength versus cash, which is just showing this broadening of the market as more and more cash start to enter the market. A lot of this has to do with the inflation numbers that have been coming out. A lot of people have been worried about inflation for this year as the numbers have hit fairly high levels, but we're starting to see the actual data points start to decline, which is a very good sign. We look at the Fed projections, we can see that those numbers are expected to decline as we go forward, which will really benefit investors who are worried about rising interest rates, because it seems like the Fed is starting to potentially take their foot off the brake a little bit. They're still pushing down on the brake, like I've been saying the last couple of weeks, but they're easing up a little bit. We see our interest rate hike cycle, nothing like what we saw in 2020, this year, 2022 going forward. You can see just how aggressively the Fed raised interest rates this year, and now it's starting to slow. They're expecting to really slow down and possibly start declining and lowering the interest rate cycle as they go forward, as the economy starts to slow and the inflation starts to slow, and really we can start looking at supporting lower interest rates going forward. So all these are lining up to be positive sign for investors. A lot of this has to do with the kind of the future outlook for Fed interest rate hikes. For really the second half of the year, the Fed got fairly aggressive with their interest rate hikes. They were raising interest rates by 0.75% of a point, and the market was anticipating that rise to continue into next year. However, really once we got around here about the beginning of December, we started to have those FOMC meetings. We had speeches by Fed Chair Jerome Powell, who was really saying they're starting to worry about things breaking in the financial system, which is what we saw in the international markets. We saw international central banks acting on the kind of intervene on their bond markets, intervene in the currency markets. And the idea was maybe the Fed was getting too aggressive and they were going to break something within the system. So it seems like the Fed took notice of that, and they're starting to talk about taking a different approach. Instead of aggressively raising rates, they raise rates at a slower pace, but just keep those higher rate levels at that higher level for a longer period of time. So you can see here a month ago, the idea of a Fed raising a rate either half a percent or 0.75% were fairly even. But once we had those meetings and the speeches by the Fed chair, you can see just the kind of the very quick change that now the market is really only anticipating a 0.5% interest rate hike at the last meeting of the year, which is December 14th. The Fed doesn't like to surprise the market, so the fact that this is still kind of the odds and the anticipation of what's going to happen at the next meeting is a good sign, because the Fed looks at things like this and they would say, okay, well, don't want to surprise the market, so we're going to start talking about this need for a higher interest rate hike. But they haven't been talking about that, so it seems it's more and more likely that the Fed is only going to raise interest rates by 0.5%, which is favorable for what the market has been anticipating. So really, I think the big theme is to look at what's been going on with those seasonal trends in the market. Again, this is kind of where we are right now, that we've had that weakness in the market first part of December as we've had those funds take those tax losses. But if the seasonal trends continue to line up as they have been, I think we can start looking at those Christmas rallies start to kick in and that anticipation of a strong year-end rally for the market. So these are areas that we're keeping an eye on for the market right now. And right now, things seem to be lining up on this. So if we don't get any surprises within the market or within some of these economic numbers that are coming forward, this, I think, is the most likely scenario of what we're looking for going forward in the market. So that's going to be it for this week. If you have any questions, please feel free to reach out to me. The best way is by email at john.rothe@riverbendinvestments.com. You can also follow me on Twitter at John Rothe. And of note, this is going to be the last market update video for the year as we all kind of take a break and enjoy the holiday season. So unless something dramatic happens, we're going to be taking off for the rest of the year on the videos. But again, if you have any questions, I'm always here. Please feel free to reach out to me. And with that said, just please, everybody, have a safe and happy holiday season and a great new year. And we'll talk in the new year. So thanks, everybody, so much. Bye-bye for now.